The institution crumbled. Trust evaporated. Billions vanished overnight. How did this happen? In the shadow of a staggering $290 million fine, Salomon Brothers faced the fallout of a catastrophic decision that reshaped Wall Street forever. The aggressive trading practices, bred in a macho corporate culture on the trading floor, paved the way for a monumental failure. It all began with a fatal decision by trader Paul Mozer, who sidestepped crucial client identification protocols during Treasury auctions. This breach not only shattered the foundation of market integrity, but also sent ordinary investors into chaos, undermining their financial futures. What was lost? Trust, the bedrock of financial markets. Who lost it? Everyone from individual investors to financial institutions that believed in the system. Why does this matter? Because the reverberations were felt across the globe, pushing regulatory bodies to reevaluate the very framework of trading practices designed to protect clients and maintain order in the financial system. At Salomon Brothers' bustling trading floor, fueled by a culture that celebrated bold risks, the pressure to perform led traders to overlook significant warning signs. As confidence in the system grew, so did complacency. It marked the beginning of a downward spiral as inexperienced traders, intoxicated by the promise of profit, ignored the lurking dangers. An influx of trades flagged the brewing storm, but too many were locked into the belief that their strategies could weather any tempest. As the stakes escalated, small losses grew into a mountain of risk. The relentless pursuit of profits turned into reckless abandon. The liquidity crisis hit, forcing management into a frantic scramble to salvage their reputation. What began as isolated incidents snowballed. The atmosphere grew more frantic and volatile. Decisions became increasingly desperate as trust disintegrated. The ominous day arrived when the consequences finally caught up with them. Regulators came crashing down, armed with fines and sanctions, dismantling the facade of a once respected institution. The plummet from grace was swift and calamitous, leaving Salomon Brothers in ruins, and the aftermath left a gaping void felt by investors and traders alike. In the wake of this disaster, personal stories emerged from the wreckage. Crying investors recounted the losses of life savings, families displaced by financial ruin, and traders haunted by their roles in a failed system. The psychological toll extended beyond the balance sheets. It permeated communities and shattered lives, as confidence in the financial sector was irrevocably shaken. Regulatory bodies faced an urgent imperative to restore faith in a system deeply compromised. Stricter compliance measures were rolled out, designed to iron out the creases in accountability and transparency. The financial world recognized that the thrill of risk could no longer eclipse the necessity of ethical trading practices. The lasting lesson from this monumental fallout is clear. Transparency is paramount. When corporate culture prioritizes profit over ethics, the cost is more than financial. It constitutes a fundamental breach of trust that resonates for generations. As we navigate the complexities of modern finance, let us remember the story of the $290 million fine, a haunting reminder that the price of failure is not just measured in dollars, but in the very fabric of our collective trust in the futures it secures.